Hey there, welcome to lecture 22. We're going to talk about the nuances between each type of market. And the reason why we want to do that is because these nuances affect the way price can move in the markets. And it's a good idea to have some context behind the actual asset class you're trading so you don't just apply very dry and stale price action analysis to a chart, because these nuances can definitely affect the intricacies of how you want to use price action analysis and how you want to execute on those markets. So we're going to go through those here, and they're really good to keep in mind as you go forward and execute on each different type of market and expand into different asset classes. So we already went through some of these quantitative differences in the mean reversion momentum lecture. For example, equities that tend to mean revert versus futures and FX that have more momentum characteristics. But let's dive into a little more detail. So some good questions that you want to ask yourself before you apply technical analysis and enter the market are as follows. What are the strengths and weaknesses of your strategy in each different market? Which markets are you focused on right now? How does the market you are trading typically behave? Does it trend over the long haul? Does it move in cyclical patterns? Who's trading the market? Why are they trading it? So these questions are going to help you be a little more selective in the actual trades you take, and make sure you're not trying to fit a round peg into a square hole by applying a entry technique or a price action analysis technique to a particular market that it might not be very congruent with at the current time. So here's some things that we want to keep in mind for equity indices. They're mean reverting. There's a constant upward drift because the financial system is levered long. We have built-in survivorship bias. So remember, an equity index is actually something that's constantly selling losing companies and buying winning companies. So obviously that's much, much different than, say, a bond. These things are never going to go to zero because of this built-in survivorship bias of selling losers and buying winners. And we have maximum participation, right? Retirement accounts are all in these things. Large institutions, retail trades them, hedge funds, quants, HFT. Pretty much everyone's involved in the large equity indices. And we get medium amounts of volatility. And if you're trading the ETFs, you're going to have to deal with dividends. So on the chart of the NASDAQ E-minis, we can see here how this thing's never going to go to zero, right? So despite the big crash, it's not like a company like an Enron that's going to go bankrupt to zero, because we're dealing with a basket of companies. And we can also see here that in general, the bias is to the long side, because the financial system is levered long and people are constantly piling into the long side of something like the NASDAQ. And then from a volatility perspective, we have a medium amount of volatility. So these down moves, around 17%, which I would consider medium amount. It's not like a stock which can drop that in one day. It has a medium amount that's digestible. So when you trade these, you're not going to necessarily need that much leverage to get decent returns out of them. Now, for individual stocks, they are more likely to trend because we have, if you think about the indices are a bunch of things mixed together, an individual stock's more of a pure play. So when it really trends, it can go and just absolutely take off. There's no upward price limit, but individual stocks can go to zero. You do have to worry about bankruptcy. And individual stocks are also prone to extremely large shocks or jumps on news or earnings, which makes them extremely volatile, one of the most volatile things we can trade. And as far as the player profile, everyone's in the large caps. And big players, though, are restricted from small caps. So down in the very tiny little stocks, you're not going to have the big hedge funds, the big institutions in there. It's a different ball game down there. You're just going to have maybe smaller funds and retail investors. So that's important to keep in mind. And then the dividend factor, some offer dividends, others do not. Another thing to keep in mind, if you're looking to go short, you will have to pay dividends on your short stock. So on Google here, we can see these large jumps. Let me zoom into the daily chart. You can see these large jumps and gaps from the news, and it's extremely volatile. So look at this up move in Google, almost 30%. And these gaps, let's just measure this gap right here. It was a 13.67% overnight gap right around there. So stocks are extremely volatile. They can take off, they can move extremely quickly, and they can also go to zero. So keep that in mind when you're trading stocks next time you go in to execute. Now, fixed income and bonds, they have low volatility, so they don't move as much as an equity index or a stock on a percentage basis. and the risky bonds can go to zero, but most people, especially on the retail side, are never going to be trading actual individual risky bonds. But bond indices and sovereign debt, it's extremely unlikely for it to go to zero. We have to deal with coupon payments in the form of dividends and ETFs, and prices move cyclically depending on the economic environment and Fed policy. So we do have trends in interest rates, but on a long term, we do see a more cyclical nature than, for instance, the S&P 500, which is just going to keep trending up and up and up in perpetuity. And we have all major players trading this market except retail. So retail tends to stick to stocks, FX, some futures. Not many retail traders trade individual bonds. It's mostly a professionals game. And then a really important thing to understand is that long-dated bonds are more volatile and trendy than short-dated bonds. And this is a concept called duration or convexity. As a general rule, for every 1% increase or decrease in the interest rates, a bond's price will change approximately 1% in the opposite direction for every year of its duration. So if a bond has a duration of 5 years and the interest rates increase by 1%, the bond's price will decline by 5%. And conversely, if a bond has a duration of 5 years and interest rates fall by 1%, the bond's price will increase by approximately 5%. So let's take a look at the difference between, say, 30-year bonds versus the 2 years. So the 30-year bonds, we can see very nice trendy movements and also a little more volatility. The latest fall here, let's just measure it real quick, was around a 16% fall. Now, if we go to the 2-year notes, you can see it's a much different story. So they're much more stable on a percentage basis. They're barely moving. So in contrast, let's see what this down move was, only a 1% down move. And that's because the duration's so much shorter. So they're less prone to be whipped around by interest rate changes. So typically for traders, we like to stick to the longer dated stuff because it's moving a little bit more. But there's something to keep in mind when you're looking through the fixed income markets is the longer dated stuff tends to be more volatile. Now for commodities, these things can be very volatile or quiet depending on the supply and demand dynamics in the market. We also have to deal with seasonal effects and their sensitivity to inflation. But the one thing with commodities is there's no price ceiling, so things can get really nutty to the upside, but we don't have to go to zero. So there's not like a commodity can go bankrupt. So crude oil is never going to trade for $0 a barrel, but it can go have an insane rallies to the upside because of inflation effects. And then different commodities have different characteristics. So before you trade a commodity, just look at the chart and see how it moves. Some of them have very large gaps and don't move that much. Others trade very much like an equity index. It's very all across the board. So you got to get a good feel for yourself when you're scrolling through all the charts of the different commodities. It just takes a little bit of time. The players in the field are professional CTAs and commercial producers. Those are the most active people, and we see this hedgers versus speculators concept. So speculators in general are trend followers, hedgers are the opposite. And commodities are only playable through the futures market. There are some ETFs available, but the structure of them makes them undesirable to trade. And because they're only playable through the futures market, we have to worry about contango and backwardation effects and chart gaps. So contango and backwardation just refers to the shape of the curve on the futures market. So contango curve means prices are getting more expensive as time goes out, and backwardation means prices are getting cheaper as time goes out. So there's something to be aware of in the futures market. So feeder cattle, you can see, has a lot more gaps in the price, and that's due to differences in the curve from contango and backwardation effects. So we see these pockets where something like gold's not going to have that. It's the price from rollover to rollover is much more close and clear, so we don't have those huge price gaps. So each commodity has its certain characteristics. Just be sure to look at the charts and get a feel for how it's moved in the past, so you know how to best execute on it going forward. And then finally we have FX. So FX is a relative value trade, so it's really a spread, and they're based on interest rate differentials that are controlled by macro and government policy. So the things that we have to watch out for here are the positive and negative carry implications. So it costs money to hold a currency if you're shorting a currency that has a higher interest rate than the one that you're going long. And that's because you have to pay more on your short interest than you earn on the long interest. And then another thing you have to worry about is the risk of pegs breaking by central banks causing black swan events. So these are two nuances that are specific to FX markets that we need to know about before we're executing on them. And then finally, they're extremely liquid, but they have low volatility, so we need lots of leverage to make it worth our while to trade them. And pretty much all institutions, businesses, sovereigns are active, retail as well, but not as active as retail would say being stocks. Let's look at the USD franc cross, and this huge down move on the weekly, this was when the Swiss bank broke the peg with between the franc and the euro, and we had that black swan movement. So that's definitely something we got to watch out for in FX. And then let's just measure the volatility of FX. You guys can see, so the moves are relatively small, so that's 3%. And this down move, which would be considered a black swan event in the currency market, was only a 17% down move. So, something like Google, that's just a normal earnings announcement, but in FX, a 17% move is huge. And that's why typically we use a lot of leverage when trading FX, because if you see these trends, right, like an actual trend maybe only be a 5% up move. Another thing to be aware about is this long versus short price action. And especially in equities, they trade differently long than they do short because of the fact that the entire financial system is levered long, and most people like to buy and be long and not short. So they do trade differently, and we have this escalator up, elevator down phenomenon that occurs. And bull trends tend to be less volatile and last longer with shallow dips, whereas bear trends are way more volatile and shorter with larger retraces. So you can see on this chart of Apple, we have the bull trends, which have fairly shallow retraces. And then this one's a really good example of the retraces are fairly shallow all the way up. And then as soon as we have a bear trend, we can see they have sharp retraces. So Apple was moving down, but very, very sharp retraces on the short side versus relatively muted retraces on the upside. So understanding these nuances are necessary to fit your tools to the market correctly. And that can help you from taking a bunch of losing trades because your entry technique or your analysis technique is not quite calibrated to the market, because each market's a little bit different. And you want to make sure you're aware of the specific patterns and characteristics, and then tweak the overall trading strategy you're going to use based on the individual market. So for instance, on futures, you might only want to use breakouts, where on equities, you might look into failed breakouts or be willing to purchase pullbacks. And you can sort of tweak your entry strategy depending on the market that you're trading.